Hello, friends. A very good morning to all of you. After knowing the scope and importance of financial management or business finance, it is essential to know the finance function or financial decision in detail. So, there are a number of financial decisions are there that I'm going to deal today in detail. So, as the financial decision refers to the decisions concerning financial matters of a business firm, and there are many kinds of financial management decisions that the firms makes in pursuit of maximizing shareholders wealth, like the kind of assets to be acquired, what will be the pattern of capitalization, like what will be the distribution of firms income, and etc. So number of decisions have to be taken carefully here under this financial decision, and we classify these decisions into following major groups. So financial decision is broadly classified into long-term financial decision and short-term financial decision. Long-term financial decision includes your financing decision, investment decision, and dividend decision, whereas short-term financial decision includes your liquidity decision or working capital decision. And I'm going to discuss all these four decisions in detail in next slides. But before knowing what is financing, what is investment, what is dividend decision, and what is liquidity decision, it is necessary to know what do you mean by long-term financial decision and short-term financial decision. So the long-term financial decision here means this finance decision has longer time horizon and involves a period of more than 1 year, and they may affect the firm's performance and value in the long run. So long-term financial decisions are those decisions which involve long time period, that is more than 1 year, and the financial executive have to take such decision for a longer period of a time, and those decisions in future may affect the value of the firm as well as the firm performance. Whereas short-term financial decision, as this function involves a period of less than 1 year, so these decisions are needed for managing the firm's day-to-day funds requirement, like to meet the working capital, for meeting the day-to-day transaction of an enterprise. So those funds and those requirements related to such decisions, such investment has to be taken. Generally, they relate to the management of current assets and current liability, means that can easily be liquidated within a period of 1 year, as well as it is related to the short-term borrowings and investment of surplus cash for short period. So whatever the transaction that is within a period of 1 year, and the decision related to such transaction, whether it's a purchase of assets or whether it's a payment of liabilities or related to the arrangement of funds to meet the day-to-day requirements, all such decisions are taken here under short-term financial decision. Now talking about the long-term finance decision, and the first long-term finance decision is financial decision or capital mix. So it is important to make wise decision about when, where, and how should a business acquire funds. Means firm have to continuously doing the planning for the new financial needs, from which sources they are going to get the funds. If their future requirement is for a short period, then short term financial requirement is to be taken care of, and if the funds are required for a long period of a time, then long term sources of the funds have to be taken care of. So it depends upon the type of requirements of a firm, and on those type of requirement, the type of sources of funds can be considered: short term sources of fund or long term sources of fund. And the financing decision is not only concerned with how best to finance the assets or how to make arrangement of the funds or procurement of the funds, but also it is concerned with the overall mix of financing of the firm. That is, broadly speaking, a correct ratio of an equity and debt has to be maintained, and the mix of equity capital and debt is known as firm's capital structure. So a finance manager has to select such sources of funds which will make optimum capital structure. That means an important decision has to be taken with respect to proportion of various sources of fund, as well as what will be the overall capital mix of a firm. Means the debt equity ratio should be fixed in such a way that it will helps in maximizing the profitability of the concern. The raising of more debts will involve fixed interest liability and dependence upon outsider. It may help in increasing the return on equity also, but will also enhance the risk. And the raising of funds through equity will bring permanent funds to the business, but the shareholders will expect higher rate of earning. So the financial manager has to strike a balance between various sources so that the overall profitability of the concern gets improved. And if the capital structure is able to minimize the risk and raise the profitability, then the market price of the share will goes up, and it will leads to maximize the wealth of the shareholders. Thus a firm tends to benefit most when the market value of the company's share maximizes. This is not only a sign of growth for a firm, but also it helps in maximizing the shareholders' wealth. So a sound financial structure is said to be one which aims at maximizing the shareholders' return with minimum risk, and in such a scenario the market value of firm will maximize, and hence an optimum capital structure would be achieved. Now, after financing decision, the next decision is investment decision. And investment decision is related to the determination of total amount of assets to be held in the firm and the composition of these assets and the business risk complexions of the firm as perceived by the investors. So the most important financial decision is the investment decision. Since the funds involve cost and are available in limited quantity, so its proper utilization is very necessary to achieve the goal of wealth maximization. Thus, the most important finance function is to intelligently allocate capital to long-term assets. And this entire activity is known as capital budgeting. Main purpose of investment decision is to allocate capital in those long-term assets so that maximum benefits can be earned in the future. And for this, the investment decision can be classified under two broad groups, that is long-term investment decision and short-term investment decision. And the long-term investment decision is known as your capital budgeting, and the short-term investment decision is working capital management. So here we will be dealing with the long-term investment decision, and the short-term investment decision we will be dealing in your working capital decision or the liquidity decision. As capital budgeting is the process of making investment in the capital structure, and these are the expenditures, the benefits of which are expected to be received over a long period of a time exceeding 1 year. And the finance manager has to assess the profitability of various projects before committing the funds, and the investment proposals should be evaluated in terms of expected profitability, the cost involved, the risk associated with the projects. And the investment decision is important not only for setting up new units but also for the expansion of present units, replacement of permanent assets, research and development, project cost, and reallocation of funds. So apart from setting up new unit, certain decisions for the expansion of present unit is also taken here under investment decision. And following are the two aspects of investment decision. First is evaluation of new investment in the terms of profitability, and another one is comparison of cutoff rate against new investment and prevailing investment. So these decisions need to be taken here under investment decision. The third major financial decision relates to the dividend decision or profit allocation, that it is related to the disbursement of profits back to the investors who supplied capital to the firm. So here the term dividend refers to that part of profit of a company which is distributed by its among its shareholder, and it is reward of shareholders for investment made by them in the share capital of the company. Here the decision is concerned with the quantum of profit to be distributed among shareholders, and another decision has to be taken whether all the profits are to be distributed or some profits are to be retained for doing business, or all the profits are retained in business. So these kind of decisions are to be taken here under dividend decisions. The higher the rate of dividend, then it may raise the market price of shares, and thus it maximizes the wealth of the shareholders. And the firm should also consider the question of dividend stability, like stock dividend, that is bonus share, or cash dividend. So which type or what are the forms of dividend, what can be the type of dividend policy, all such decisions are taken here under dividend decision. And it's the financial manager's responsibility to decide an optimum dividend policy which maximizes the market value of the firm. And for this, an optimum dividend payout ratio is calculated. So it's a common practice to pay regular dividend in case of profitability, and another way is to issue bonus share to the existing shareholder. So it depends upon the type of dividend policy as well as the form of dividend which is opted by any enterprise in their business activity. Now talking about the last decision, that is the short-term finance decision, is liquidity decision or the term assets mix. So it is very much important to maintain a liquidity position of a firm to avoid insolvency, and the firm's profitability, liquidity and risk all are associated with the investment in current assets. So if investment is to be done for a short period of a time, then three factors, that is liquidity, profitability and risk, these three factors must be taken care of and all are associated to it. So a proper decision which is influenced by trade-off between liquidity and profitability is taken here under liquidity decision. The reason is that the more liquid the assets, the less it is likely to yield, and the more profitable in assets, the more illiquid it is. And a sound short-term investment decision or working capital management policy is one which ensures higher profitability, proper liquidity and sound structural health of the organization. And this can be achieved only when the current assets should be properly valued and disposed of from time to time once they become non-profitable. And such current assets must be used in times of liquidity problems and times of insolvency. So a proper trade-off between profitability and liquidity is required to maintain here, and a decision with respect to it is taken by the financial executive. So that's all for today. Thank you everyone. Have a nice day.